This week, as you've probably seen in the news, Leopold Aschenbrenner, I'm just going to call him Leo because that's a ridiculously long name. He had a fund which blew up. Now, he's, over the last couple of years, last couple of months, been on podcasts, been known as this AI whiz kid, this AI genius, because of what he's done with his hedge fund. But in this video, we're going to talk about what we can take away and actually learn from his mistakes so we don't make the same mistakes. Remember, this is a cornerstone research, it's personal analysis. Please, don't take this as financial advice. If you do want to keep up to date with financial markets, I do have a free newsletter. Link to that will be in the description. What happened? So Leopold Aschenbrenner built up his own fund, which is called Situational Awareness. He loves a long, complicated name, doesn't he? To 45 billion with over 400% gains. And in short, it blew up. He is Forex leverage, long, and he had to, his margin calls were triggered from various other banks, and it was basically, majority of it was bought by Ken Griffin's Citadel fund. So, in short, he was leveraged long, and he was margin call because, as we know, that AI, semis, memory, all these sort of stocks, they've had long run-ups, and then they've obviously been dropping over the last couple of weeks. And then, as you can see there, these are some of the positions obviously he was in. So Bloom Energy, Sandis, CoreWeave, Iran. I've never even heard of Iran. I think that's how you pronounce it. And Core Scientific. Again, those bottom two I've not even heard of until I was doing the research for this. So all super long moves, all massive runs. However, we've got a 12 and 21 EMA there. They broke down. This is just chop. That was a wrong bet. This, assuming he got in there, obviously that's just lost momentum for ages now. And yeah, as you can see, that's obviously been a bit of a slower grind up. But yeah, if you're Forex leveraged and you have a 25% loss, that's 100%. So as you can see here, some of his positions are massive, and he clearly didn't take profits, or he didn't exit on some strategies. Now, he maybe was planning to exit further down the line, but a lot of people assume he was just holding on for dear life, thinking there'd be another leg. And as we all know in markets, you can't pray and hope for what's going to happen. So this is a really interesting concept. So being right and being early is sometimes not enough. So Leo was ultimately right about AI infrastructure having enormous returns over the last months, the last couple of years. But doesn't always mean you're going to make money, which is really interesting thing about markets. You could have the correct thesis, you could have the correct idea, but still lose money. So if you cannot survive being early, early in the trends and take those profits, you're ultimately going to lose your money. So as we talked about earlier, a 25% drawdown at Forex leverage can be a 100% loss. So we don't know his entries into this, but he was right. But he clearly wasn't managing risk. So I assume he was adding size there, probably there. So it's a really interesting concept. So the chart was already showing weakness before the margin calls were hit. We go back again. Weakness, you've had structure breaks, that's just gone sideways. For this type of situation, with stocks, I think it's all about momentum, unless it's a 10-year, 20-year hold. So you want to hold something for the momentum, or if you have a thesis, you want to hold it until that thesis is complete. And for me, for example, I would have been out of there. I maybe would still be long these if I was lower. This one, again, I'd be out. And this one, again, I'd probably still be in. That's just from my own approach, just because those moving averages haven't crossed on a high time frame. But if I was to get in there and we were stalling for a couple of weeks, I'd be out, because I think when stocks move, they move, and they do tend to just run away from you. So kind of going back to this, so conviction in the thesis is not a substitute for position sizing. So if you think gold is going to be the next thing over the next 5 years, you could be right. Gold could go to 10,000, but if you're leveraged and you're adding positions and you're long and you get wiped out, then you don't make any money. So being right and being early is sometimes not enough. Risk management, I guess, as a summary to this slide, is always more important than your thesis and kind of what you're doing. And it's following a plan which you can build into risk management as well. So I want to talk about leverage here, because I think leverage is really misunderstood when it comes to financial markets. So leverage is a capital efficiency tool, not a size multiplier. So leverage is designed to make better use of your existing capital, not multiply the existing, money that you've got. So let's say, for example, you've got $10,000. You've got $10,000. your job should not be to make your portfolio $20,000, $30,000, $40,000 in his case with 4x leverage. Your job should be, okay, cool, I've got $10,000. How can I place or how can I buy something? And if I'm going to use leverage, how can I buy something but then have more of my money left? So let's say, for example, if you're going to have 10,000 and you're going to have a 1% risk on a trade. So let's say if the thesis is invalid, your stop loss gets hit, you lose $100. What you do is you lose leverage to make sure you can size that in correctly. That's the correct use of leverage. So 4x leverage on a concentrated bet is not capital efficiency. It's a binary bet. So you've got to view leverage as capital efficiency, not a size multiplier. I think this is quite a misunderstood concept that not many people do speak about. And we've got there Stanley Druckenmiller that averaged 30% for 30 years without letting leverage destroy him. He went 200% short in the British pound versus the German, I can't remember what it was, the German currency at the time. And he went 200% of the funds. Now he would have had, obviously you're probably thinking, oh, but that's the same as Leo. But Druckenmiller would have, not done that all at once. He would have added to it, but he would have had an invalidation. So Stanley Druckenmiller, again, somebody who uses leverage, but he would use it as a capital efficiency tool. But that's a really interesting thing because, Druckenmiller going 200% is, similar to Leo's 400%, but Druckenmiller, when he's using leverage, he would be having it as a capital efficiency tool for some positions, or when he does go all in on a investment, he would have very strict invalidations. Otherwise, you wouldn't be doing 30% for 30 years, right? You got to have that. So a defined exit and a position sizing are not optimal. They are the strategy. So you need to have a idea of the exposure risk that you want to have on the position, and that can be done by leverage. And remember, it's a capital efficiency tool, not a size multiplier of your portfolio. So the difference between intelligence and wisdom. So Leo had intelligence, but Ken Griffin had wisdom. Ken Griffin is a bit of a shark. He's been around for a while. So Ken Griffin's Citadel, built its entire risk culture around treating forced selling as an opportunity. So Ken Griffin, again, is like licking his lips or rubbing his hands at people like Leo. So we've got there, obviously, something from Tim, from a former Bloomberg columnist. The meltdown shows the difference between intelligence and wisdom. Really good thing. Again, the intelligence of Leo to get into those positions early, but the wisdom of somebody like Ken Griffin, who knows how to manage things correctly, and he knows how to wait for opportunities when others are folding, you could say. So Citadel reportedly pushed, surprise rate hike fears in the days before the AI trade collapse. So there's a couple, obviously, things about Citadel and so on. I'd be recommend doing your own research into that, but I thought it would be worth putting in. So intelligence got him to, 45 billion. Wisdom would have kept him there. He would have taken some profits. The good thing is, though, Leo's learned the lesson. Yes, he lost a lot of money, but he's learned it at a young age. So he'll be able to bounce back, I'm sure, and keep going. But the market does not care about how smart your thesis is. It cares where you can survive. It cares, whether you can survive being early. So remember, you've always got to have that thesis defined exit when you're doing something. And remember, capital efficiency when it comes to leverage. That's the correct use of leverage. So if your friend says they've got a position of 15x leverage, you might think, oh my God, why has he done that? The littlest drop in his portfolio, he's going to lose all his money, but he actually might be using it as a capital efficiency tool so he can take bets in other places, if that makes sense. Before this was interesting putting in, intelligence, which Leo had, but he didn't have the wisdom to, maybe size correctly, put leverage on in the right places, or take profits when trends had clearly broken. So the IPO pattern struck again. So, we spoke about this in a previous video. So, one of the IPOs that Leo was listed in, the AI sector peaked almost at the exact moment. So that's really interesting. Buying a IPO when it gets released to the public, he may have gotten early, but as a retail investor, getting in an IPO, in my opinion, you're better letting it, play out over a year or so. That's a much better play. So, SpaceX is a great example. It's just gone down. You're better off just letting it play out, seeing what happens, probably getting 6 months of a chart history or maybe some more earnings calls. We've got obviously that coming up. Get that data and then make decisions, because it's really hard, because what you'll have the people who are in before gets listed and it dumps. And we see this all the time in markets. So the chart told you, before the listing, confirmed it. So that, we have the ETF there. It already broken down. We spoke about this in another video about memory. Memory stocks were showing weakness. And yeah, I think it really is interesting to see kind of, with IPOs that you don't want to be aping in. You want to have, first of all, a plan. And my plan would be just wait 6 months to see if we do have any strength and anything we can actually take bets on. So lists are exits, not entries. So smart money, potentially, as I mentioned earlier, IPO gets listed, they just sell. So right, or there might be a lockup period, so they can't sell for a couple of weeks or so, but once that's done, they just sell. And that tends to happen quite a bit, which we spoke about a lot. The verdict, being right and being early is not enough, right? So that is really important. You've got to remember, you can be right on an investment, you can be right on a trade idea, you can be early into something, you can still make not enough money. Bitcoin could be a really good example. People could have been right on Bitcoin in 2017, but sold during COVID. See? So you can be right, okay, cool, I'm going to be this. But then because you don't stick to your plan, because you use leverage or misuse leverage, you can be wrong, ultimately. Leverage is a capital efficiency tool. It's really important to do this. When people are saying, I was leveraged on my portfolio, I was leveraged on that, context is really key. Oh, what were you using leverage for? Oh, I was 200% on my portfolio. Okay, cool. You're not Stan Druckenmiller, you're probably gambling. Whereas, in other instances, leverage, can be used as that capital efficiency tool to spread your bets more smartly, you could say, and use your money more effectively. And the IPO pattern struck again. As you can see here, IPOs just tend to sell off. We spoke about the ETF in other videos. Memory stocks under pressure. That could have been, a sign of it, things to come. So, look, if you want to keep up to date with markets, I do have a free newsletter. Link to that will be in the description, and I'll see you in the next one.